SoFi just recently announced the upcoming agendas for the annual meeting of stockholders. The fifth proposal has caught the eye of many. It says, quote, to approve an amendment to the company's certificate of incorporation to give the board of directors discretionary authority to effect a reverse stock split. It's important to note that this vote is to authorize the board to do a reverse stock split. For some reason, this is not a vote to perform a reverse stock split. This gives the board the authority to do so if needed, kind of like an in case of emergency break glass move. Some people think that stock splits could cause dilution. So does that mean reverse stock splits increase ownership percentage because they are technically less shares? The short answer is no. The question then arises, how could this potentially affect the stock? In this video, we will look into the potential pros and cons of the reverse stock split, and also how reverse stock splits have affected other companies' stock prices in the past. SoFi stock seems to have just started to recover, and now the wrench of a reverse stock split is getting thrown into the mix. Could this reverse stock split throw SoFi back into a downward spiral? Or instead, is this exactly what SoFi needs to continue to push higher? Let's take a look at a bank, yes, a huge bank that has been in the same scenario, and see how that affected their stock price. In this video, we'll go over the technical details of this announcement, what it really means for you as a SoFi investor, and why we think panic is not the best way to absorb this news. Disclaimer, we're not financial advisors, and this is not financial advice. This is solely our opinion, so always do your own due diligence. First things first, let's go over the technical details of this controversial news. Anthony Noto and the SoFi gang just announced that they'll be having the annual shareholder meeting with a very interesting agenda. SoFi is about to discuss and vote on the company's amendment to the company's certificate of incorporation, with a goal to effect a reverse stock split, and apparently that would have to change the total number of authorized shares in the market. Now, what does this actually mean? Well, this will reduce the number of common shares and outstanding redeemable preferred stock, taking a ratio of not less than 1:2 and not more than 1:10. But nothing is final just yet. What they're really trying to do is increase the share price by combining them. Here's what Commander Noto has to say on the matter.
I've had enough.
There's many SoFi investors freaking out, and rightfully so, but we're here to tell you that freaking out may be in vain. Before you panic, here are 2 reasons for this key move according to SoFi. Number 1, appeal to investors, at least probably institutional investors. According to Investopedia, companies that trade under a $5 a share price can be considered penny stocks. Certain institutions may have constraints on investing in penny stocks, which may make them pass on SoFi. To avoid this, doing a reverse stock split would bring the share price way above the penny stock territory. Since institutions on average have significantly more capital than retail investors, it is in the best interest of companies to appeal to institutional investors. Number 2, earn the trust of the market. Being in the penny stock price range comes with negative connotations. Penny stocks have earned a bad rap of being more risky, speculative investments. All of these things SoFi does not want to be associated with. SoFi literally just got out of the negative connotations associated with going public through a SPAC, and you could argue that some of that negativity is still hanging around. The last thing SoFi wants is to be associated with all the BS that goes on in the penny stock range. SoFi is a quality company as proven by their recent Q1 2022 earnings call. However, even quality companies can get caught in the perfect storm. Potential world wars, inflation skyrocketing, stock market crashing fears, real estate market bubble fears, overall, just a lot of fears. All these things have played major roles in bringing the market down, and consequently, SoFi with it. For those of you who don't know what a reverse stock split is, we've got you covered. Investopedia defined a reverse stock split as something that happens when a company wants to reduce its number of outstanding shares in the market. Existing shares are then combined with proportionally more valuable shares, and eventually this results in a boost in the company's stock price. So, say you own 100 shares of a stock with a $20 per share price. When a company decides to make a 1-for-10 reverse split, you'll just get 10 shares instead of 100 shares. But how much is the worth of your shares now? Before the split, you own 100 shares worth $2,000. And if you do the math for the split, 10 shares that are worth $200 each would also mean a $2,000 value in your portfolio. Now, for the cons. Number 1, the reverse stock split may not increase the price of SoFi's common stock over the long term. Before you panic, hear this. It may reduce the number of shares for an increased share price for the time being, but this does not mean that the market is done dipping. And if the market dips, it will often take SoFi with it. While this may be confusing to some, let's just remember change is constant, and so are share prices. At the end of the day, Mr. Market is a crazy guy. Number 2, the reverse stock split could signal weakness. Stock splits are typically seen as a, quote, our stock price is so high because we're killing it so hard right now that people may not be able to afford to invest in our company. Or, in simple terms, a sign that things are going so well, effectively pricing people out of the ability to invest. Now, a reverse stock split may actually signal the opposite, essentially saying, quote, our stock price is so low that people don't want to touch it because it's essentially a penny stock, and penny stocks are scary. So let's reverse split and raise it, which, although it is true, is not a good look and could signal weakness, which could possibly draw in more short sellers, which equals no bueno. Some people are thinking the reverse stock split will give bears more ammunition to short SoFi, and only time can really tell. SoFi is finally starting to bounce back, but this uncertainty caused by the announcement of a vote on a potential reverse stock split has investors a little apprehensive. But as they say, quote, in investing, what is comfortable is rarely profitable. Here are what some sources have to say about stock splits. Quote, companies are doing reverse stock splits for 2 key reasons. First, to stay listed on major exchanges, and second, to stop being a red flag to investors and analysts who only care about share prices. But there is the ultimate red flag though, and that is not being subscribed to Wealth Gambit. Currently, we're at 3,852 subscribers, and it shows that 71% aren't subscribed, so make sure to hit that subscribe button so you can stay updated on our posts. Robert Johnson, a financial analyst at the Economic Index Associates, once said that, quote, just as stock splits are a sign that a firm is thriving, reverse stock splits are an admission of a struggling firm and a huge red flag. But in SoFi's case, this is not at all true. Here's the Wealth Gambit take on it. SoFi, the company, is not struggling. In fact, quite the opposite. All key metrics are better than ever. The only thing about SoFi that is struggling is the stock price. This reverse stock split is an effort by the SoFi board of directors to help the stock price. A lot of people have been reading way too much into this, and in our opinion, there's really no need to go deeper than that. Raise the stock price and get away from the low stock price negative connotations. After all, even Amazon, the trillion-dollar e-commerce giant, was at one point in time in the $6 a share range.
Our stock went down to 6. It went from 113 to 6 in less than a year. My annual shareholder that year starts with a one-word sentence, and that one-word sentence is the word ouch.
Let's flash back in time and look at Citigroup before 2011. Back then, for the price of one Arizona iced tea, you could even get a share of Citigroup stock. Yes, you heard that right. The famous bank Citigroup, which operates in more than 100 countries, not only entered the penny stock territory, but even had a staycation there. All jokes aside, during this time, the shares fell as low as 97 cents, and that brought more than $277 billion of market cap to just $6 billion. Dow Jones and the New York Stock Exchange both agreed to buy more time for Citigroup to recover and escape from getting delisted. Citigroup is now moving at around $51 per share today at the time of recording this. If you've watched until this point, don't forget to subscribe and comment SoFi will 10x down below in order to get a shout out in our up and coming videos. Also, comment down below your thoughts on this reverse stock split. Will this be a good thing or a bad thing for SoFi investors? We want to know your thoughts. So here's the juicy part. In 2011, the company went through a 1-for-10 reverse stock split, bringing their $4 per share price to over $40 per share, and years after, it never went back to the penny stock category. It even rallied to about $70 to $80 per share before the health crisis began. But we're not done yet. How is this related to SoFi? Well, aside from the obvious fact that it's going through the same reversal stock split, Citibank was breaking records before the split. In 2010, it recorded its first year of 4 profitable quarters since 2006, and it had significantly improved earnings and cash flow. Now you know why Citibank might be looking at SoFi right now and whispering,
Been there, done that.
Things get even juicier. Did you know that Warren Buffett just bought a whopping $3 billion in stake in Citibank this year? It seems that the Oracle of Omaha just went on a shopping spree on this undervalued bank after heading out from Wells Fargo, which has been in his portfolio for more than 3 decades. Who knows, maybe Warren Buffett may stumble upon SoFi one day. At least we have our fingers crossed. If you haven't already, check out our social media accounts and join our SoFi Investors Facebook page. Link will be in the description and pinned comment. Shouts out to everyone who commented on our previous videos. Thanks for the support, guys. Also, special shout out to everyone in our Patreon community who truly helped to make these videos possible. We really appreciate the support. Shouts out to Arthur Magazu, Wei Chu, Pietro Serra, Daniel Corbett, Mr. Welfare, Casey Patel, Jeff Sherman, Gregory Villar, Bo Park, Denzel, Shonda, Reginald Davis, Les Broadway, Christian Cardelphi, Kevin Beaufrond, and Jay Bone. That wraps it up for today's video, guys. What are your thoughts on this news? Are you still in panic mode or not really? If you found any value in this video whatsoever, please smash that like button for the YouTube algorithm, and don't forget to subscribe to get more content like this and help us hit our goal of getting 4,000 subscribers. Until next time, peace.